Before we begin, please remember that this presentation is for informational and educational purposes only. I am not a financial advisor, and the information provided in this video does not constitute financial, legal, or tax advice. The home loan process is complex and unique to every individual. You should always consult with a qualified and licensed professional, such as a mortgage loan officer and a financial advisor, before making any major financial decisions. Imagine this for a second. You've been scrolling for months. You've driven through neighborhoods you never knew existed. You've sacrificed your weekends, dragging yourself to open house after open house. And then you find it. The one. It's not just a house. It's the place you can see your life unfolding. The backyard is perfect for a dog. The kitchen gets that amazing morning light, and it's in the right school district. Your heart is pounding. This is it. You've saved every penny you could. You've been paying your bills on time. You feel ready. So you put in the offer, it gets accepted, and you apply for the loan. And then you wait. A week later, an email lands in your inbox. Your stomach drops. You open it and the words leap off the screen. "We regret to inform you. Denied." No clear reason why. Just a cold corporate rejection that slams the door on your dream. That gut-wrenching feeling of being told no, without understanding why, is the single biggest fear for American homebuyers. And it happens hundreds of thousands of times every single year. But what if I told you that for a huge number of those people, the reason for their denial was something they could have easily fixed, if only someone had pulled back the curtain and shown them what the lenders are actually looking at? That is exactly what we are going to do today. Forget everything you think you know about getting a mortgage. We are going on a deep dive into the mind of a loan underwriter. This isn't about generic advice like save your money or have a good credit score. This is the insider's playbook. By the end of this video, you will understand the secret language lenders speak. You will know precisely what they scrutinize, what they value, and what sends up a giant red flag. You will walk away with a crystal clear, actionable roadmap to transform your loan application from a hopeful long shot into an undeniable top-of-the-pile, approved stamp. So where do we start? Most people think it all comes down to one thing: your credit score. That 3-digit number you see on Credit Karma or your banking app. And they are dead wrong. That number is just the tip of the iceberg. What the lender is really evaluating is your entire financial identity, which rests on 3 massive pillars. And today we're going to dismantle the first and most misunderstood pillar of them all: your true creditworthiness. First, let's get one thing straight. The credit score you see for free online? That's almost certainly a VantageScore. It's a great educational tool, but it is not the score your mortgage lender uses. It's like practicing for your driver's test by playing a video game. The skills are related, but the real test is a completely different beast. Mortgage lenders use a much older, more conservative, and frankly tougher scoring model called the FICO score. Specifically, they use a tri-merge of 3 classic FICO models: FICO Score 2 from Experian, FICO Score 4 from TransUnion, and FICO Score 5 from Equifax. They take all 3 scores, throw out the highest, throw out the lowest, and use that middle number as your official mortgage credit score. Why does this matter? Because these older FICO models weigh things differently. They can be more sensitive to certain negative events and less forgiving than the newer Vantage scores you see online. This is why people are often shocked to find their official mortgage score is 20, 30, or even 50 points lower than the score they've been tracking on their app. They walk in thinking they're a 740, but to the lender, they're a 690. That's the difference between a great interest rate and a much more expensive loan, or even an approval and a denial. So what do these FICO scores actually care about? They are built on 5 key components, and understanding how an underwriter sees them is the first key to unlocking your approval. The single most important factor, making up a massive 35% of your score, is your payment history. This sounds simple, right? Pay your bills on time. But it's so much more nuanced than that. An underwriter doesn't just see a check mark for paid. They see the entire story. A single 30-day late payment from 4 years ago is a minor blip. But a 30-day late payment 3 months ago? To them, that's not a mistake. It's a flashing neon sign that says current financial stress. They're thinking, if you can't handle your $200 car payment today, how can we trust you with a $3,000 mortgage payment next month? The recency and a frequency of any late payments are absolutely critical. One late payment is a stumble. Multiple late payments, even if they were a year ago, start to look like a pattern of behavior. And underwriters hate unpredictable patterns. Next up, accounting for 30% of your score is an element called amounts owed, but what we really mean is credit utilization. This is your secret weapon. Your credit utilization ratio is the amount of revolving credit you're using divided by your total credit limit. You've probably heard the rule of thumb. Keep it below 30%. That's okay advice. But if you want to look like an absolute rock star to a lender, you keep your utilization below 10%. Here's why. Someone with a $10,000 credit limit who owes $3,000 looks responsible. But someone with that same limit who owes only $500 looks like they are in complete control of their finances. High utilization signals to a lender that you might be living on the edge, relying on credit to make ends meet. It screams risk. Lowering your utilization is the single fastest way to boost your FICO score before you apply for a loan. Pay those balances down and you will see a significant immediate impact. The third component at 15% is the length of your credit history. This is where so many people make a critical mistake. They'll have an old credit card they never use, one they opened in college, and they'll think, I should close this account to clean things up. That is a catastrophic error. That old account is likely your longest-standing credit line. It's the anchor of your credit history. When you close it, you can dramatically shorten your average age of accounts, which makes you look like a less experienced and therefore riskier borrower. Lenders love to see long, established credit histories. It shows a long track record of responsible behavior. Never ever close your oldest credit cards, especially not in the year or two before you plan to buy a home. Making up 10% of your score is your credit mix. Lenders want to see that you can successfully manage different types of debt. There are two main categories: revolving debt, like credit cards where the balance can go up and down, and installment loans like an auto loan or a student loan, where you pay a fixed amount every month for a set term. An applicant with a healthy mix, say a couple of credit cards, a car loan, and a student loan all in good standing, looks far more appealing than someone who only has credit cards. It demonstrates a breadth of financial responsibility. It shows you can juggle different payment structures and deadlines, which is exactly what a mortgage is. Finally, the last 10% is new credit. This is a huge red flag for underwriters. If they pull your credit report and see that you've applied for 3 new credit cards and a personal loan in the last 6 months, they don't see someone who's building their credit. They see someone who is desperate for cash. Every time you apply for new credit, it results in a hard inquiry on your report, which can temporarily ding your score. 1 or 2 are no big deal. But a flurry of them right before a mortgage application? It suggests financial instability. The rule is simple. Once you decide you're serious about buying a home, you go into a credit lockdown. No new car loans, no new credit cards, no financing a new sofa. Your financial picture needs to be as stable and boring as possible. These 5 factors, your payment history, your utilization, your credit age, your credit mix, and your new credit inquiries, combine to create the FICO score the lender sees. It's not just a number. It's a detailed story of your financial reliability. And mastering this story by paying on time, keeping balances low, preserving your old accounts, maintaining a healthy mix, and avoiding new debt is the first, non-negotiable step to getting that approval. But remember, this is just the first pillar. And in some ways, it's the easiest one to fix. Because what a lender is even more concerned about is the second, even bigger pillar, your actual verifiable ability to repay the loan. And that's where we go next. Think of your income not as a single number, but as a story. A lender doesn't just want to know the final chapter, how much you made last month. They want to read the whole book. They're looking for stability, predictability, and a track record. They're essentially asking, can we bet a few $100,000 that your financial story will have a happy ending for the next 30 years? And the proof they demand comes in 2 primary flavors, which we can think of as easy mode and hard mode. Let's start with easy mode. This is for the W-2 employee. If you work for a company, get a regular paycheck, and receive a W-2 tax form at the end of the year, congratulations. In the eyes of a mortgage lender, you are a golden goose. Why? Because your income is stable, predictable, and most importantly, it's verified by a third party, your employer. The lender can call your HR department and confirm your salary, your start date, and your job title. There's very little guesswork. So what do they need from you, the W-2 employee? It's pretty straightforward. First, they want to see your 2 most recent pay stubs. This shows them your current rate of pay, your year-to-date earnings, and any deductions. Second, they'll want your last 2 years of W-2s. This establishes your history. It shows them you've been earning consistently. Are you making more this year than last year? Great. That shows upward mobility. Now, a common fear is, what if I just change jobs? What if I've only been at my new company for 3 months? Am I disqualified? In most cases, absolutely not, as long as you've stayed in the same line of work. If you were a software engineer at Google and you just moved to a senior software engineer role at Microsoft with a pay raise, a lender sees that as a positive. It's a step up. You're still a software engineer, you just have a better paying gig. The only time a recent job change raises a red flag is if it's a total career pivot. If you went from being a salaried accountant to a commission-only car salesman last month, the lender has no history to base your future earnings on. They'll likely ask you to wait until you have a longer track record in the new role. Lenders will also typically verify your employment verbally right before you close on the house. They'll call your employer one last time to ask a simple question. Is this person still employed here? So, pro tip, don't quit your job the week before you get the keys to your new house. But what about bonuses or overtime? This is a crucial detail. Let's say your base salary is $70,000, but last year you made an extra $30,000 in overtime. Can you qualify for a loan based on a $100,000 income? The answer is maybe. For income that isn't guaranteed, like overtime, bonuses, or commissions, lenders need to see a 2-year history of you receiving it. They need to believe it's a consistent and reliable part of your compensation, not a one-time fluke. They'll take your W-2s from the past 2 years, average out that variable income, and add it to your base salary. If you got a huge, one-time bonus last year but nothing the year before, they're probably not going to count it. Consistency is king. Now let's switch to hard mode. This is for the freelancers, the gig workers, the small business owners, the 1099 contractors. If you are self-employed, you need to listen very, very closely. The rules are completely different, and this is where so many aspiring homeowners get a brutal reality check. A lender looks at a self-employed person with a healthy dose of skepticism. It's not personal. It's just that your income isn't guaranteed by a major corporation. It can fluctuate wildly. You could have a monster month followed by a terrible one. So, to get comfortable, they need to see an ironclad, multi-year history of success. The non-negotiable price of admission is almost always 2 full years of tax returns showing your self-employment income. If you just quit your job 6 months ago to start a consulting business, even if you're making fantastic money, you will almost certainly have to wait until you have 2 years of filed tax returns under your belt. And here is the single biggest mistake self-employed borrowers make. Let's say you're a freelance graphic designer. Last year, you billed your clients a total of $150,000. You're thinking, great, I'll get a loan based on a $150,000 income. Wrong. Absolutely fundamentally wrong. Lenders do not care about your gross revenue. They care about your net income after all your business expenses. They look at the number you actually pay taxes on. So, you take that $150,000 in revenue, then you subtract the cost of your new MacBook, your Adobe software subscription, your home office deduction, your marketing costs, your travel to a conference, everything you legally wrote off to lower your tax bill. Let's say your write-offs totaled $60,000. Your net taxable income is now $90,000. That is your qualifying income in the eyes of the lender. This is the great paradox of being self-employed. The same tax strategies you use to save thousands of dollars from the IRS can simultaneously kneecap your ability to qualify for a mortgage. Every dollar you write off is a dollar the lender pretends you never earned. And it gets tougher. Just like with bonuses, they will typically average your net income from the last 2 years. So, if you netted $90,000 last year, but only $70,000 the year before, your qualifying income isn't $90,000. It's the average, $80,000. And what if your income went down? What if you made $90,000 2 years ago but only $70,000 last year? Now you have a real problem. A lender sees declining income as a massive red flag. They will likely either use the lower, more recent number, the $70,000, or they might get so nervous they deny the loan altogether. For the self-employed, a consistent or rising income trend is absolutely critical. So the playbook for the self-employed is this. For the 2 years leading up to your home purchase, be very strategic about your write-offs. It might be worth paying a little more in taxes for those 2 years in exchange for qualifying for the home you really want. Of course, income isn't always from a 9 to 5 or your own business. Lenders will consider other sources, but again, they all have to be documented and stable. Have a part-time job you've worked for 3 years? Great, they'll likely count that income. Just started driving for Uber last month? Sorry, that's too new to be considered reliable. Do you own a rental property? They'll typically take the gross monthly rent, subtract the mortgage payment on that property, and then only use 75% of the remaining positive cash flow to account for potential vacancies and repairs. Receiving court-ordered child support or alimony, you can use that as income, but you'll need to provide the divorce decree or court order and proof that you've been receiving it consistently for at least 6 months, and that it's scheduled to continue for at least 3 more years. Every dollar you want to use to qualify for your loan must have a paper trail. It has to be sourced, seasoned, and stable. So, we've talked about your credit score, your history of borrowing. Now we've talked about your income, your ability to earn. But a lender needs to connect these two pillars. They need to weigh what's coming in against what's going out. They do this with one of the most important and most misunderstood numbers in all of finance. It's a single percentage that can make or break your homeownership dreams. It's called the debt-to-income ratio, or DTI. This ratio is the underwriter's holy grail. It's the master formula that tells them exactly how much of your monthly income is already spoken for by other debts, and therefore, how much is left over to safely afford a mortgage payment. Your credit can be perfect and your income can be high, but if your DTI is out of whack, you will be denied. It is the final gatekeeper. And in the next part, we are going to break it down piece by piece. We will explore every single debt that goes into this calculation, from student loans and car payments to those retail credit cards you forgot you even had, to reveal the magic number that lenders are looking for. So let's pull back the curtain on that magic number. It's called the debt-to-income ratio, or DTI. And it is, without a doubt, the single most important metric in the mortgage world. Forget what you think you know. Forget the complex formulas you might have seen online. At its core, DTI is brutally simple. It's a snapshot of your financial life that answers one question for the lender. After you pay all your existing monthly debts, how much money is left over to pay for a house? Imagine your gross monthly income, that's your income before any taxes are taken out, is a freshly baked pie. Every single monthly debt payment on your credit report is a slice of that pie that's already been promised to someone else. Your car payment is a slice. Your student loan is a slice. That minimum payment on your credit card? That's a slice too. The lender's job is to look at how much pie is left and decide if it's enough to give you another, very large slice for a mortgage. If too much of your pie is already spoken for, they're going to walk away from the table. It's that simple, and that critical. Now, lenders actually look at this in 2 different ways. They calculate 2 separate DTI ratios. The first is called the front-end ratio, or the housing ratio. This one is straightforward. It's just your future, proposed total housing payment. We're talking principal, interest, taxes, and insurance, often called PITI, divided by your gross monthly income. For example, if your new house payment is going to be $2,000 a month, and your gross income is $8,000 a month, your front-end DTI is 25%. This number tells the lender what percentage of your income will be dedicated solely to keeping a roof over your head. But the one that really matters, the one that makes or breaks most deals, is the back-end ratio. This is the big one. The back-end DTI takes all of your monthly debt obligations. That means your new proposed house payment plus your car loans, student loans, credit card payments, and any other loans, and divides that total by your gross monthly income. This gives the lender the complete picture. It's not just about whether you can afford the house. It's about whether you can afford the house while also affording the rest of your life's financial commitments. So what exactly gets counted in that debt part of the equation? This is where so many people get tripped up. Let's start with the obvious ones. Your car payment. That brand new SUV with the $700 monthly payment isn't a symbol of success to an underwriter. It's a $700 liability that directly reduces the amount of house you can afford. Next, personal loans. That loan you took out for a new deck or to consolidate debt. It's on the list. And of course, student loans. We'll come back to those in a minute, because they are a huge, complicated beast of their own. Then we have the sneakiest debts of all, credit cards. This is a massive point of confusion. You might be a financial superstar, paying off your $5,000 balance in full every single month before the due date. You think you have zero credit card debt, right? Wrong. In the lender's eyes, you don't. An underwriter doesn't look at your habits. They look at your credit report. And your credit report shows a balance and a required minimum monthly payment. So even if you pay it all off, they will take that minimum payment, usually about 1 to 2% of the balance, and count it against you as a monthly debt. If you have a $10,000 balance, they might hit you with a $100 or $200 monthly payment in their calculation, even if your personal budget for that card is zero. The same goes for those retail store cards you signed up for to get a 20% discount. The Kohl's card, the Best Buy card, the Home Depot card. Even if you haven't used them in years, if they carry a balance, the minimum payment is counted as debt. And it gets deeper. We have to talk about the debts people completely forget. Things like alimony or child support payments you're legally obligated to make. Those are counted dollar for dollar. A loan you co-signed for your kid's first car? If your name is on that loan, it is your debt, even if you've never made a single payment yourself. You have to prove, usually with 12 months of bank statements from the primary borrower, that someone else has been making the payments on time for the lender to even consider excluding it. And what about that furniture you bought on a no-interest for 24 months deal? If it shows up on your credit report as an installment loan, it's included. But the real giant in the room, the one that sidelines more millennial and Gen Z buyers than anything else, is student loan debt. The rules here are complex and they can feel incredibly unfair. Let's say you have $100,000 in federal student loans, and you're on an income-based repayment plan, so your required monthly payment is currently $0. You think that means it doesn't count against your DTI, right? Absolutely wrong. This is a brutal wake-up call for many buyers. Because your payment is subject to change, lenders won't use that $0 figure. Instead, for conventional loans, they will typically calculate a payment for you, usually by taking 1/2 of 1%, that's 0.5%, of your total loan balance and treating that as your monthly payment. So on $100,000 of student debt, even with the $0 required payment, the lender adds a $500 monthly debt to your DTI calculation. That $500 could be the difference between getting approved and getting denied. It could reduce your purchasing power by $75,000 or even $100,000. FHA loans are even stricter, often using a full 1%. It's a silent deal killer that many people never see coming. Now, just as important is knowing what isn't included. This is where you can breathe a little. Your monthly utility bills, gas, electric, water, not included. Your cell phone bill, not included. Car insurance, groceries, daycare costs, your Netflix and Spotify subscriptions, none of it is counted in your DTI. These are considered living expenses, not contractual debt obligations that show up on a credit report. So while you absolutely need to budget for them, the lender's formula ignores them completely. So we've dissected the D in DTI. We know what gets counted. The big question is, what are the magic numbers? What DTI ratios are lenders actually looking for? It varies by loan type, but there are some solid rules of thumb. For most conventional loans, the ones backed by Fannie Mae and Freddie Mac, the ideal back-end DTI is 43% or lower. This is the gold standard. It means that no more than 43 cents of every dollar you earn before taxes is going toward your total monthly debts, including your new house. Now, can you get approved with a higher DTI? Yes, with strong compensating factors like an excellent credit score, a large down payment, or significant cash reserves. Lenders can sometimes stretch that limit up to 45%, or in some rare cases even as high as 50%. But once you cross that 43% threshold, the scrutiny intensifies dramatically. Government-backed loans are more forgiving. FHA loans, which are popular with first-time buyers, are known for allowing higher DTIs. It's not uncommon to see approvals with back-end DTIs of 50% or even higher, sometimes up to a staggering 56.9%. This flexibility is a huge reason why FHA loans are so accessible. Similarly, VA loans for veterans and USDA loans for rural areas also have more lenient DTI guidelines, recognizing that these borrowers may need more leeway. To see how this plays out in the real world, let's imagine two different buyers, Mike and Jessica. They both have the exact same job, earning a gross income of $7,000 a month. They both have great credit scores and have saved up the same $30,000 for a down payment. On the surface, they are identical candidates, but their debt is a different story. Mike has a $600 monthly payment on his new truck. He also has about $8,000 spread across a few credit cards, resulting in about $200 a month in minimum payments. His total existing monthly debt is $800. If we target a 43% back-end DTI, the lender calculates that his total debt, including a mortgage, cannot exceed $3,010 per month. Since he already has $800 in other debts, that leaves only $2,210 available for a total monthly house payment. Now let's look at Jessica. She drives a reliable, paid-off car, so she has no car payment. She uses her credit cards for points but pays them off every month, keeping her reported balances near zero. Her only debt is a small student loan with a $150 monthly payment. Using the same 43% DTI limit on her $7,000 income, her total allowable debt is also $3,010. But since she only has $150 in existing debt, she has $2,860 available for a house payment. That's over $600 more per month than Mike. Over the life of a 30-year loan, that difference in monthly payment translates into Jessica being able to afford a house that is nearly $100,000 more expensive than Mike's, all because she managed the D in her DTI. Same income, same savings, same credit score, wildly different outcomes. So you've meticulously managed your debt, you understand your DTI, and you think you're in the clear. But what if I told you that the I in DTI, your income, is just as complicated, and that not all the money you make is considered equal in the eyes of a lender? That huge commission check you got last quarter? The income from that side hustle you've been grinding on for the last year? To an underwriter, it might be worth absolutely zero. In the next part, we are going to expose the hidden, often frustrating rules of income qualification and show you exactly how lenders verify every single dollar you claim to earn. So, how do they do it? How does a lender take your life's work, your hustle, your side gigs, and your career, and boil it all down to a single number on a spreadsheet? The process is less of an art and more of a brutal, unforgiving science. It's about one thing and one thing only: documentation. If you can't prove it with the right paper, in the right format, it simply doesn't exist in their world. Let's start with the simplest case, the one lenders love because it's clean and predictable: the W-2 employee. If you get a regular paycheck from a company with taxes taken out, you are the golden child of mortgage lending. Verification for you is straightforward. First, they'll ask for your most recent pay stubs, usually covering a 30-day period. They're looking for your year-to-date earnings, your hourly rate or salary, and to make sure nothing looks weird. Are you suddenly getting a massive unexplained pay bump right before applying for a loan? That's a red flag. Next, they'll want your W-2s for the past 2 years. This is the official form your employer sends to the IRS. It's the lender's way of confirming that what you're making this month is consistent with what you've made over the last 24 months. They are building a picture of stability. A single pay stub shows a snapshot. 2 years of W-2s show a feature film. But the final nail in the coffin, the ultimate source of truth for them, is something you never even see. It's called a written verification of employment, or WVOE. The lender sends a form directly to your employer's HR department, and your employer fills it out and sends it back. This form verifies your start date, your position, your pay structure, and most critically, it asks a golden question. What is the probability of continued employment? Your employer's answer to that question is huge. The lender isn't just lending you money based on your past. They're betting on your future. That third-party verification straight from the source is what makes W-2 income so powerful and easy to qualify with. Now let's step out of that clean, well-lit room and into the messy, complicated, and often infuriating world of the self-employed. If you're a freelancer, a small business owner, a gig worker, or anyone who gets a 1099 instead of a W-2, you are playing the game on hard mode. The entire philosophy changes. The lender no longer has an HR department to call. The only person they can ask about your income is you. And respectfully, they don't entirely trust you. They trust the IRS. For you, the holy grail of documentation is your federal tax returns. Not 1 year, but 2. This is almost always non-negotiable. They want to see 2 full years of filed tax returns, all pages, all schedules. Why 2 years? Because self-employed income can be volatile. You might have a killer year where you land a massive contract followed by a lean year. A lender needs to see the average, the trend. They are terrified of lending based on a single outlier year of high income that might never happen again. So they take the net income from your last 2 tax returns, add them together, and divide by 24. That's your monthly qualifying income. Let's say in 2022, you made a net profit of $60,000. And in 2023, you crushed it, making a net profit of $140,000. You're feeling great, thinking you can qualify based on that $140K. But the lender looks at that and says, okay, $60K plus $140K is $200K. Divide that by 2 years, that's an average of $100K per year. That's the number they use. That incredible year you just had? It gets diluted by your previous lower income year. It's frustrating, but it's their rule for establishing stability. But here is the single biggest trap that snags self-employed borrowers, the one that causes the most shock and anger. It's the issue of write-offs. As a business owner, your accountant's job is to use every legal deduction possible to lower your taxable income. Your home office, your cell phone bill, your mileage, that new laptop, supplies, meals, all of it reduces your net profit on paper so you pay less to the IRS. And that is smart tax strategy. But when it comes to getting a mortgage, it is absolute poison. The lender does not care about your gross revenue. They don't care that you billed $200,000. They only care about the number you reported to the IRS as your final net profit after all those deductions. You cannot have it both ways. You can't tell the government you only made $50,000 to save on taxes, and then turn around and tell the bank you made $200,000 to buy a house. The number on your tax return is the number, full stop. I have seen people who make $250,000 a year in revenue get denied for a mortgage because they wrote everything down so aggressively that their tax return showed a net income of only $30,000. Every dollar you spend on your business to lower your tax bill is a dollar you are taking away from your ability to qualify for a home loan. What about other types of income? The rules are just as specific. Let's talk about bonuses or overtime. You might have gotten a huge $20,000 bonus last year, but if you don't have a 2-year history of receiving that bonus, the lender will likely disregard it completely. They see it as a one-time event, not a stable, reliable source of future income. They need to see it on your W-2s for 2 consecutive years and get verification from your employer that it's likely to continue. The same goes for overtime. If you just started pulling extra shifts 3 months ago to pump up your income, it won't count. You need a 2-year track record to prove it's a consistent part of your compensation. What about a part-time job? Again, the 2-year rule is king. If you started delivering for DoorDash 6 months ago to save up for a down payment, that income is invisible to the underwriter. You must have held that second job consistently for 2 years for it to be considered part of your stable monthly income. Even things that seem simple like rental income have a catch. Let's say you own a rental property and the tenant pays you $2,000 a month. You might think, great, that's $2,000 in income. The lender will say, not so fast. They will typically only use 75% of that gross rent, so $1,500. Why? Because they automatically factor in a 25% vacancy and maintenance factor. They know that over the life of the loan, you'll have months where the property is empty, or you'll have to replace a water heater. They build that buffer in, which reduces your qualifying income. Underpinning all of these rules for every type of income is one core principle. One question the underwriter is trained to ask over and over: is this income stable, and is it likely to continue for the next 3 years? That's the magic number. 3 years. Your W-2 job with a major corporation? Yes, very likely to continue. Your brand new freelance business that had one great year? The jury's out. That overtime you've been working for the last 28 months straight? Okay, that looks pretty consistent. That one-time consulting gig that paid you a fortune? No, that was a fluke. This is why the system feels so rigid. It's not designed to understand the nuance of your career or your hustle. It's a machine designed to minimize risk by looking for one thing: a documented, predictable pattern of income that it can reasonably project forward for the next 36 months. You have to prove, beyond a shadow of a doubt, that your financial movie is a stable drama, not a roller coaster of an action film. So you've done it. You've gathered the pay stubs, the W-2s, the tax returns. You've navigated the brutal rules of income verification and built an airtight case for what you earn. Your income is locked in, verified, and approved. You're in the clear, right? But what if I told you that even with a 6-figure rock-solid income, a tiny forgotten $15 a month student loan payment could be the one thing that stops the entire process dead in its tracks? Because proving your income is only half the battle. The other half is proving you're not drowning in debt. In the next part, we're going to pull back the curtain on the silent killer of mortgage applications: your debt-to-income ratio. And it all comes down to a single, deceptively simple percentage. Your debt-to-income ratio, or DTI, is the lender's X-ray vision. It's how they look past your impressive salary and see the real story of your monthly cash flow. Think of your financial life as a scale. On one side, you pile on your gross monthly income, everything you earn before taxes. On the other side, you stack up all your monthly debt payments. The lender's only real question is, which side is heavier? And by how much? If your income side is weighed down firmly on the ground, you look stable. You look like a safe bet. But if that debt side starts to creep down, making the scale level out, or worse tip, you look risky. You look like someone who's one unexpected car repair away from a financial catastrophe. That's why DTI is a non-negotiable metric. It's a hard and fast calculation that tells a lender exactly how much of your monthly income is already spoken for, before you even pay for groceries, gas, or that Netflix subscription. They're not just lending you a huge sum of money. They're betting on your ability to manage that new massive payment on top of everything else you already owe. Your DTI is their crystal ball for predicting your future financial stress level. Now, lenders actually look at two different DTI numbers. The first is called the front-end ratio, also known as the housing ratio. This one is simple. It only looks at your potential housing costs. The lender takes your future estimated mortgage payment, that's principal, interest, taxes, and insurance, what we call PITI, and they divide it by your gross monthly income. For example, if your new mortgage payment is going to be $2,000 a month, and you make $8,000 a month, your front-end ratio is 25%. Historically, lenders like to see this number at or below 28%. It's a quick gut check to see if the specific house you want is within a reasonable range for your income. But the one that truly matters, the number that separates approvals from denials, is the back-end ratio. This is the big one. This is your total DTI. It takes all of your minimum monthly debt payments, your car loan, your student loans, your credit cards, everything, and adds the new potential mortgage payment on top. Then it divides that total sum by your gross monthly income. This number gives the lender the complete picture. It shows them what percentage of your paycheck is flying out the door each month to service debt. Let's imagine two people, both named Sarah. Both Sarahs make exactly $100,000 a year, which is $8,333 a month. Both have saved a 20% down payment, and both have a great credit score. On the surface, they are identical, perfect applicants. They both want to buy a house with a monthly PITI payment of $2,500. But here's the difference. Sarah number one has no debt, no car payment, no student loans, no credit card debt. Her back-end DTI calculation is simple. $2,500 for the mortgage, divided by her $8,333 income. Her DTI is 30%. The lender looks at this and breathes a sigh of relief. She has 70% of her income left over every single month for taxes, savings, and living expenses. She is a prime candidate. Now let's look at Sarah number two. Same income, same down payment, but she has a $500 a month car payment. She has $400 a month in student loan payments. And she has a couple of credit cards with a total minimum monthly payment of $150. Her existing monthly debt is $1,050. Now the lender adds the new $2,500 mortgage payment to that. Her total monthly debt obligation would be $3,550. When you divide that by her $8,333 income, her back-end DTI is 42.6%. Is she still a good candidate? Maybe, but she is no longer a sure thing. She's right on the edge. See, for most conventional loans, the absolute maximum DTI a lender can typically accept is 43%. It's a hard ceiling set by government regulations that define a qualified mortgage. Some programs like FHA loans or special portfolio loans might stretch to 45, 47, or even 50% in rare cases, but you'll face more scrutiny and potentially higher interest rates. Sarah number two, who thought she was a perfect applicant, is now one small miscalculation away from an automatic denial. That's the power of the debt-to-income ratio. It's a pass/fail test you take before the real test even begins. So what exactly are lenders adding to that debt pile? This is where so many people get tripped up. It's not just the obvious stuff. Of course, they're including any existing mortgages, car loans, and personal loans. But they're also including things you might not even think about. Student loans are a huge one. Even if your loans are in deferment or forbearance and you aren't currently making payments, the lender doesn't care. They know you'll have to pay them eventually. So if your credit report doesn't show a monthly payment amount, they will use a formula. They'll typically take 0.5% or even 1% of your total student loan balance and use that as your hypothetical monthly payment. If you have a $100,000 student loan balance, a lender could add a $500 or even a $1,000 monthly payment to your DTI calculation, even if you're paying zero right now. This single factor torpedoes countless mortgage applications. Credit cards are another tricky one. Lenders don't care about your total balance. They only care about the minimum monthly payment listed on your statement. If your minimum is $100, that's the number they use even if you always pay the card off in full. And here is the biggest, most misunderstood trap of all: co-signed loans. Let's say you co-signed on a car for your brother 5 years ago. He's never missed a payment, and you haven't thought about it in years. Well, the lender thinks about it. Because your name is on that loan, That debt legally belongs to you just as much as it does to him. That $500 monthly payment goes directly into your DTI calculation, even if you've never paid a dime. The only way to get it excluded is if you can provide 12 months of bank statements from your brother, proving he, and only he, has been making the payments. If you can't get that documentation, that loan is yours in the eyes of the bank, and it could be the difference between approval and denial. What doesn't count? Your day-to-day living expenses. Utility bills, cell phone plans, car insurance, gym memberships, streaming services. These are not considered debt obligations and are not included in your DTI. The lender assumes you'll pay for these out of the income you have left over after all your debts are paid. So if you calculate your DTI and the number is scarily high, what can you do? You're not stuck. You have two levers to pull: increase your income or decrease your debt. Increasing your income is the harder path, but if you have a side business or are due for a significant raise, that will certainly help. The more controllable lever for most people is decreasing the debt side of the scale, but you have to be strategic. The goal isn't necessarily to reduce your total amount of debt, but to reduce your total monthly payments. The fastest way to do this is to attack your smallest loans first. If you have a small personal loan with a $150 monthly payment, and you can pay off the remaining balance of $1,000, you have just permanently removed $150 from your monthly debt calculation. That has a much bigger and more immediate impact on your DTI than paying an extra $1,000 towards a $30,000 car loan. Look for quick wins. Can you pay off a store credit card entirely? Can you sell something to eliminate a small loan? Every single monthly payment you can wipe off the books is a direct improvement to your DTI ratio. And whatever you do in the 6 to 12 months before you apply for a mortgage, do not take on any new debt. Don't finance furniture. Don't get a new car. Don't open new credit cards. You need to enter what's called a quiet period, where your debt load is only going down, never up. Let's go back to Sarah number 2, the one with the 42.6% DTI. She realizes her car payment is a problem. She works hard, saves aggressively, and pays off one of her high-payment credit cards, eliminating that $150 minimum payment. Just like that, her DTI drops to 40%. She's now safely under that 43% ceiling. She's feeling confident. She's done the math. She's fixed the problem. She resubmits her application, and the lender agrees. Her income and debts are now in perfect alignment. But then they dig deeper into her file. They look past the numbers on the page and into her history, and they find something that the DTI calculation doesn't show. A pattern of behavior that makes them question everything. Because getting your debts in order is only one piece of the puzzle. The other, more powerful piece is proving you have a history of paying them back on time every time. And that story is told by a single 3-digit number that holds more power than almost anything else in your financial life. Your credit score. 3 digits that can open doors or slam them shut in your face. It's a number that follows you, whispered between banks and credit card companies. A summary of your financial character boiled down to a grade. To a lender, it's not just a number. It's a prophecy. It's their crystal ball, their way of predicting the future. Specifically, predicting whether you are a safe bet or a risky gamble. Think of it as your financial trust score. Every time you borrow money and pay it back, you earn trust. Every time you're late or you miss a payment, you lose trust. Your credit score is just the running tally of all that trust you've built or broken over the years. And when you're asking for hundreds of thousands of dollars for a home, you'd better believe they are checking that score with a microscope. They aren't just looking at the number itself, whether it's a 680, a 740, or an 820. They are looking at the story behind the number. What ingredients went into creating that score? Because that story tells them everything they need to know about the kind of borrower you'll be. So let's pull back the curtain. The system most lenders use is called the FICO score. And it's not some magical, unknowable formula. It's a recipe with 5 main ingredients, each with a different weight, a different level of importance. Understanding this recipe is the single most powerful thing you can do to take control of your financial destiny. The first and most important ingredient, making up a massive 35% of your score, is your payment history. This is the king, the undisputed, heavyweight champion of your credit score. All other factors bow down to this one. It answers the most fundamental question a lender has. Do you pay your bills on time? Not most of the time. Every time. A single late payment can stain your record for up to 7 years. Think about that. A mistake you made in your early 20s could still be whispering warnings to a mortgage lender when you're 30. Lenders see a late payment, especially a recent one, as a giant flashing red light. It suggests financial distress. It suggests disorganization. It suggests that when things get tough, your bills are the first thing to slide. And if you're late on a $200 credit card bill, what's going to happen when you're faced with a $2,000 mortgage payment every single month for the next 30 years? That's the fear. That's the risk they're trying to avoid. A long history of on-time payments, on the other hand, is like a choir of angels singing your praises. It tells them you are reliable, you are responsible, you are the gold standard of borrowers. The second ingredient, and it's a close second, making up 30% of your score, is called amounts owed, or more commonly, credit utilization. This one sounds complicated, but the concept is simple. It's the amount of credit you're using compared to the total amount of credit you have available. Let's say you have one credit card with a $10,000 limit. If you have a $5,000 balance on that card, your utilization is 50%. If you have a $9,000 balance, it's 90%. To a lender, high utilization is another major red flag. It signals that you might be living beyond your means, relying on debt to stay afloat. It's like seeing someone constantly walking a tightrope. They might be fine for now, but it wouldn't take much, a small gust of wind and unexpected job loss, to send them tumbling. Lenders want to see that you have a healthy buffer. They want to know you use credit as a tool, not a crutch. The general rule of thumb is to keep your utilization below 30%. But the people with the highest scores, the 800+ club, they often keep it below 10%. They have access to a lot of credit, but they use very little of it. It shows discipline. It shows they're not overextended. It shows they are in control. Next up, making up 15% of your score, is the length of your credit history. This is the wisdom and experience portion of your financial story. Lenders love to see a long, established history of managing credit responsibly. It's one thing to have a perfect payment record for 1 year. It's another thing entirely to have a perfect record for 10 or 15 years. A longer history gives them more data. It proves that your good habits aren't just a fluke. They're a pattern. This is why one of the worst pieces of financial advice is to close your oldest credit card once you've paid it off. That card is the anchor of your credit history. Its age is a valuable asset. Closing it can actually shorten the average age of your accounts and cause your score to drop. A lender sees a long credit history as a sign of stability. You've been in the game for a while, you know the rules, and you've proven you can play it well over the long haul. The fourth ingredient, accounting for 10% of your score, is your credit mix. Lenders like to see that you can successfully manage different types of debt. This doesn't mean you should go out and get a bunch of different loans. But a healthy mix, developed naturally over time, is a positive sign. This could be a combination of what's called revolving credit, like credit cards, and installment loans like a car loan or a student loan. Having a good mix shows you can handle different kinds of financial responsibilities. A credit card requires you to manage a fluctuating balance and minimum payments. An installment loan requires you to make a fixed payment on a fixed schedule. Being able to juggle both successfully demonstrates financial maturity. It's like being a versatile employee who can handle multiple different projects. It makes you a more attractive, lower-risk candidate in the eyes of the lender. Finally, the last 10% of your score comes from new credit. This factor looks at how recently and how often you've applied for new lines of credit. Every time you formally apply for a loan or a credit card, it results in what's called a hard inquiry on your report. 1 or 2 inquiries here and there isn't a big deal, especially if you're shopping for a mortgage or a car loan within a short window of time. The scoring models are smart enough to understand that. But a flurry of applications for different types of credit in a short period? That's another red flag. To a lender, it can look like a sign of desperation. It suggests you might be in financial trouble and are trying to open up as many credit lines as possible to stay afloat. It's like a ship taking on water, and the captain is frantically trying to patch a dozen holes at once. Lenders get nervous. They prefer a slow, steady, and deliberate approach to credit. Opening a new account also lowers the average age of your history, which, as we just learned, is also a negative. So it's a double whammy. So there you have it. The 5 core ingredients: payment history, amounts owed, length of history, credit mix, and new credit. 35, 30, 15, 10, and 10%. That's the recipe. That's the formula that generates the 3-digit number that holds so much power over your life. It's not magic, it's math. And the beautiful thing about math is that it's predictable. You can learn the rules and make them work for you. Knowing what lenders are looking for inside this number is like being given the answer key to the most important test of your financial life. But knowing the ingredients is only half the battle. The real secret, the part that separates the approved from the denied, is knowing exactly how to master each of those 5 categories. It's not just about avoiding late payments. It's about what to do if you already have one. It's not just about keeping balances low. It's about a specific strategy that can rapidly boost your score in as little as 30 days. We've dissected the what, but we haven't touched on the how. And there's one specific counterintuitive trick related to your credit utilization that almost everyone gets wrong. A mistake that could be costing you the interest rate you deserve, or even the house itself. Let's talk about that trick. It's all about timing. See, most people think they're being responsible. They use their credit card, they get the bill, and they pay it in full by the due date. They think, great, I paid it off, my balance is 0, I'm building good credit. And they are. But they're leaving a massive opportunity on the table. An opportunity to manipulate their credit score upwards, legally and ethically, right before a lender pulls their file. Here's the secret the banks don't advertise. Your credit card company typically only reports your balance to the credit bureaus, Experian, TransUnion, and Equifax, once a month. And when do they report it? They report the balance that's on your statement when it closes, not the balance on your due date. Let me say that again because it is the entire key. They report the balance from your statement closing date. So let's imagine you have a credit card with a $10,000 limit. You use it for everything to get those sweet reward points. You buy groceries, gas, pay for a flight, and over the course of the month you rack up a $4,000 balance. Your statement closing date is the 15th of the month, and your payment due date is the 28th. Like a responsible person, you get your statement, you see the $4,000 balance, and you pay the entire thing off on the 27th, a day before it's due. You paid no interest. You feel great. But what did the credit bureaus see? They saw that on the 15th of the month, you had a $4,000 balance on a $10,000 limit. That is a 40% credit utilization. Remember, the golden rule is to stay under 30%, and the super user rule is to stay under 10%. So even though you paid it off and your actual balance is 0 for most of the next month, for the purposes of your credit score, you look like someone who is using 40% of their available credit. That single data point can suppress your score by 20, 30, even 40 points. Now here's the trick. The statement date hack. Using that same example, you know your statement closes on the 15th. So, on the 14th, the day before it closes, you go online and you pay off $3,950 of your $4,000 balance. The next day on the 15th, your statement closes. The balance? $50. And what gets reported to the credit bureaus? A $50 balance on a $10,000 limit. Your credit utilization is now half of 1%. To the FICO scoring algorithm, you've gone from a risky-looking 40% user to a pristine, ultra-responsible 0.5% user. You did nothing different financially. You spent the same money, you paid the same money. You just changed the timing of your payment by about 10 days. Do this across all your credit cards 1 to 2 months before you apply for a mortgage, and you can see a score jump that is absolutely staggering. This is the difference between a good interest rate and a great one. This is the difference that can save you tens of thousands of dollars over the life of your loan. For those who want to take it to the pro level, there's a strategy known in credit circles as AZEO, which stands for all 0 except 1. This means you use the statement date hack to pay every single one of your credit cards down to a 0 balance before the statement date, except for one. On that one card, you let a very small balance report like $5 or $10. Why? Because the FICO algorithm gives a slight penalty if all your revolving accounts report a 0 balance. It wants to see that you are actively and responsibly using a small amount of credit. So by having all cards at 0 except for one tiny balance, you are perfectly optimizing the utilization portion of your score. And this brings us to a huge myth I have to bust right now. You do not need to carry a balance and pay interest to build a good credit score. It is 100% false. You build credit by having accounts open, keeping them in good standing, making on-time payments, and managing your utilization. Paying a bank interest is just giving away your money. Use the statement date hack, pay your bill in full after the statement comes out, and you will never pay a dime in interest while building a rockstar credit profile. Now, credit utilization is a huge piece of your credit score, which is one of the pillars of your application. But there's another, equally important pillar that has nothing to do with your score, and everything to do with your cash flow. This is your debt-to-income ratio, or DTI. You could have a perfect 850 credit score, but if your DTI is too high, you will be denied. Period. So what is it? DTI is a simple percentage. It's your total monthly debt obligations divided by your total gross monthly income. That's your income before taxes. It's the lender's way of asking, after you pay all your existing bills, how much room is left for a mortgage payment? Can you actually afford this house without eating ramen noodles for the next 30 years? Let's break down the two parts. First, the debt. This includes your proposed new mortgage payment, and that means principal, interest, taxes, and insurance, what we call PITI. It also includes your minimum monthly payments on everything else that shows up on your credit report. We're talking car loans, student loans, personal loans, and the minimum payments on your credit cards. Even if you pay them in full every month, they will use the minimum payment shown on your report. It also includes things like alimony or child support payments. What does it not include? Things like your utility bills, your cell phone bill, car insurance, groceries, daycare. Those are living expenses, not long-term debt obligations, so they don't factor into the DTI calculation for the bank. Second, the income. This is your gross monthly income. If you get a regular paycheck, this is easy. It's the number at the top before they take out taxes, Social Security, and your health insurance. Lenders look at DTI in two ways. There's the front-end ratio and the back-end ratio. The front-end ratio is just your proposed housing payment, that PITI we talked about, divided by your income. Lenders generally want to see this at or below 28%. But the one they really care about, the big one, is the back-end ratio. This is all your debts, your new mortgage, your car, your student loans, everything divided by your income. This is the number that makes or breaks most applications. So what's the magic number? For most conventional loans, the absolute maximum back-end DTI you can have is 43%. Every dollar of your debt, including your new house, cannot exceed 43 cents of every dollar you earn before taxes. Now, some lenders can go higher, maybe up to 45 or even 50% if you have what are called compensating factors, like a massive down payment, a perfect credit score, or significant cash reserves. But 43% is the standard line in the sand. For government-backed loans like an FHA loan, the guidelines can be a little more flexible, but the principle is the same. Let's put it into practice. Say you and your partner make a combined $10,000 a month gross. Your maximum allowable debt, using the 43% rule, would be $4,300 a month. So you add it up. You have a $500 car payment. You have $300 in student loan payments. And you have a minimum credit card payment of $100. That's $900 in existing debt. So you take your max of $4,300, subtract your $900 in existing debt, and you're left with $3,400. That is the absolute maximum PITI, principal, interest, taxes, and insurance, that the lender will approve you for. That number, $3,400, dictates the price of the house you can buy. This is why paying off a small loan before you apply can have a massive impact. Getting rid of that $500 car payment doesn't just free up $500 in your budget. It increases your purchasing power by allowing for a $500 higher mortgage payment, which can translate to buying a much more expensive home. So you've optimized your credit score with the utilization trick. You've calculated your DTI and you know what you can afford. You're ready. But there's one final piece of this financial puzzle that trips up more people than you can imagine, especially in today's economy of side hustles and gig work. It's the I in DTI, your income. Proving your income to a lender isn't as simple as showing them a pay stub. They put your earnings under a microscope, and if you have bonuses, commissions, or are one of the millions of self-employed Americans, the process becomes a bureaucratic nightmare. And if you can't document your income in the exact, specific way the underwriter demands, then in their eyes, that money simply doesn't exist. It's a brutal reality of the mortgage world. You could have $100,000 hit your bank account, but if it came from a source you can't perfectly paper trail, maybe you sold a car for cash, or your grandma gave you a generous gift without a formal letter, the underwriter will simply disregard it. They will draw a line through it. Poof, gone. For entrepreneurs, freelancers, and commission-based salespeople, this isn't just an occasional frustration. It's the central challenge of getting a mortgage. The system, by and large, was built for the 9-to-5 W-2 employee with a predictable biweekly paycheck. If you don't fit into that neat little box, you're playing the game on hard mode. So, how do lenders actually try to make sense of a non-traditional income? Comes down to one word: history. They can't look at a single pay stub to feel secure, so they need to see a long established pattern of earnings. The gold standard, the absolute minimum for most lenders, is a 2-year history in your line of work. Just started your amazing new consulting business 18 months ago, and you're already earning double what you did at your old job? To many lenders, that's irrelevant. They'll see you as having an unproven, 18-month-old business, and they'll kindly ask you to come back in another 6 months. They want to see 2 full years of filed federal tax returns for your business, not 1 year and a projection for the next 2 full years. And what they do with those 2 years of tax returns is where many self-employed dreams of homeownership go to die. They don't just look at your most recent, most successful year. No, they take the net income from the last 2 years, add them together, and divide by 24. That final number, that 24-month average, is your qualifying monthly income. Let's say 2 years ago, you were just getting started and your business netted $60,000. But this past year, you knocked it out of the park and netted $120,000. You're feeling great. Your income has doubled. You're thinking the lender will see that you're on an upward trajectory. But the lender doesn't care about your trajectory. They care about their average. They will take your $60,000, add your $120,000, which equals $180,000, and divide it by 2. Your average annual income in their eyes is $90,000. That's a $30,000 haircut on what you're actually earning right now. And that's the best case scenario. What if the numbers were reversed? What if 2 years ago you netted $120,000, but this past year, for any number of reasons, a market downturn, a pivot in your business model, taking time off for family, you only netted $60,000. Now you have what lenders call a declining income. This is a massive red flag. A colossal, waving, screaming red flag. In this case, they won't even average the 2 years. They will throw out the higher earning year entirely and only use the most recent, lower number. So even though your 2-year average is $90,000, they will qualify you based on only the $60,000 income. Why? Because their job is to mitigate risk, and a downward trend is the definition of risk. They need to be confident you can make payments not just today, but for the next 30 years, and a declining income suggests that ability might be in jeopardy. This brings us to the great paradox of being a business owner in America. For 364 days a year, your goal, and the goal of your accountant, is to minimize your taxable income. You write off everything you possibly can. A home office, a business vehicle, mileage, supplies, meals, travel. You're smart. You're trying to pay as little to the IRS as legally possible. But on the one day you decide to apply for a mortgage, that brilliant strategy becomes your own worst enemy. Because the number you show the IRS is the only number the mortgage lender will use. They don't look at your gross revenue. They don't care that your business brought in $250,000. They only look at the final adjusted net income after all your brilliant deductions. So you walk into the bank, proud of your $250,000 year business, and the lender looks at your tax return, sees you wrote off $180,000 in expenses, and says, "Congratulations, you have a $70,000 year income." You've effectively written off your ability to qualify for the house you want. This is without a doubt the single biggest and most painful mistake self-employed borrowers make. They spend years diligently lowering their tax burden, only to find they've simultaneously destroyed their borrowing power. The key, if you're self-employed and have dreams of owning a home, is to plan years in advance. You have to sit down with your accountant and have a very different conversation. The conversation is no longer, "How can we lower my tax bill?" It becomes, "What is the minimum net income one need to show for the next 2 years to qualify for the house I want? And how do we strategically get there?" It might mean foregoing some deductions. It might mean paying more in taxes for those 2 years. It's a painful trade-off, but you are essentially paying the IRS in order to pay the bank. You're investing in your future borrowing capacity. Beyond tax returns, you'll also need to provide a year-to-date profit and loss statement, or a P&L. This document shows all your business revenue and all your business expenses for the current year, up to the most recent month. The underwriter will scrutinize this to make sure your income is on track to meet or exceed the previous year. If it's January and you're providing a P&L, it's not a big deal. But if it's October and your P&L shows your income is trending 20% lower than last year, you're right back in that declining income danger zone, and your application could be dead on arrival. They'll also want to see several months of business bank statements to verify that the revenue you're claiming on your P&L is actually being deposited into your accounts. They are cross-referencing everything. The tax return, the P&L, the bank statements, it all has to tell one consistent, stable, and believable story. This is why having clean, separate finances is non-negotiable. If you're running your business out of your personal checking account, commingling funds, paying for groceries and business software from the same pot of money, You are creating an accounting nightmare that an underwriter will not even try to solve. They will simply deny the loan. You need a dedicated business bank account, meticulous bookkeeping, and ideally, a professional accountant or bookkeeper who can prepare these documents for you. So you've navigated this labyrinth. You planned ahead, you strategically filed your taxes for 2 years, your P&L is solid, your books are clean. You've finally proven your income in a way the lender understands. You've conquered the most complex part of the underwriting process. But your journey isn't over, because proving you earn enough money is only half the battle. Now you have to prove you have enough money. The lender needs to see your assets. They need to verify every single dollar you plan to use for your down payment and closing costs. And they need to see that you'll have a cushion left over after the transaction is complete. This is where we dive into the world of sourcing funds, acceptable assets, and the all-important cash reserves that can make or break your approval at the finish line. Lenders call this sourcing and seasoning. They want to see where every dollar for your down payment and closing costs came from, and they want to see that it's been sitting in your account for a while, usually at least 60 days, which covers 2 full bank statement cycles. Why? Because they need to verify 2 critical things. First, that the money is legally yours and not from an unapproved source, and second, that it isn't a secret, undisclosed loan that you'll have to pay back on top of your mortgage. Think of your bank statements as the first few chapters of your financial story. An underwriter is reading this story, and any large unexplained deposit is like a missing page. A $5,000 deposit that just appears out of nowhere a week before you apply for a loan? That's a plot hole. The underwriter's job is to fill that hole. Was it a gift? Was it you selling your vintage comic book collection? Or was it a loan from your buddy that you promised to pay back, which now represents a new, hidden debt? They have to assume the worst until you prove otherwise. This is why the #1 rule of sourcing funds is: create a crystal clear paper trail for everything. Every single dollar. So what are the acceptable sources? The cleanest and simplest source is your own checking or savings account. If the money for your down payment has been sitting there for 3, 6, or 12 months growing steadily from your paychecks, that's perfect. That's a boring story, and in the world of mortgage underwriting, boring is beautiful. But what if you don't have it all sitting in one place? Life is more complicated than that. Maybe you're pulling money from your retirement account. A loan or a withdrawal from your 401k is a very common and acceptable source. You'll just need to provide the terms of the loan or the withdrawal paperwork. The lender will factor the 401k loan payment into your debt-to-income ratio. But it's a clear, documented, and legitimate source of funds. Another acceptable source is the sale of a significant asset. Did you sell stocks? The lender will want to see the brokerage statement showing the sale and the subsequent transfer of funds into your bank account. Did you sell a car or a boat? This gets a little trickier. You can't just say, "I sold my Honda for 10 grand. You need to provide a copy of the title, a bill of sale signed by both you and the buyer, and a copy of the check or wire transfer, plus the deposit slip showing that money landing in your account. You have to connect all the dots for the underwriter. Now let's talk about the big one, the source of more confusion and last-minute panic than any other: gift funds. It's incredibly common for parents or family members to help with the down payment. Lenders are perfectly okay with this, but they have very strict rules. First, the gift must be a true gift. That means there is absolutely no expectation of repayment. To prove this, the person giving you the money, the donor, must sign a formal gift letter. This is a legal document that states their name, their relationship to you, the exact dollar amount of the gift, and a sentence explicitly saying, "This is a bona fide gift, and there is no expectation of repayment." Second, the lender will need to source the donor's funds. Yes, you heard that right. They need to verify that your donor actually has the money to give. So your Aunt Carol, who's gifting you $20,000, will need to provide her own bank statement showing she had that $20,000 available before she transferred it to you. This prevents fraud schemes where the money is being funneled through a third party. And third, the gift must come from an acceptable source. Generally, this means a close relative, a parent, grandparent, sibling, or spouse. Gifts from a fiancé are also usually fine. But a gift from your boss, your real estate agent, or the person selling you the house? Absolutely not. That's considered an interested party contribution, and it's a massive red flag for a conflict of interest. The biggest mistake people make with gift funds is depositing the cash first and telling the lender later. Imagine your dad hands you a check for $50,000. You gratefully deposit it. A week later, your lender sees this massive unexplained deposit on your bank statement, and the alarms go off. Now you're scrambling to get a gift letter and source your dad's funds, potentially delaying your closing. The correct way is to talk to your loan officer first. Tell them you're receiving a gift, get the gift letter paperwork ready, and document the transfer from your donor's account directly to yours, or even better, directly to the escrow company. So we've covered the good money. What about the bad money? The unacceptable sources of funds are a short but critical list. Number 1 is cash. Mattress money. If you have $20,000 in a safe at home, you cannot just walk into the bank, deposit it, and use it for a down payment. Any large cash deposit will be immediately flagged. In the eyes of a lender, that cash has no origin. It could be from illegal activities or an undocumented loan. Your only option if you have a lot of physical cash is to deposit it into your bank account and let it season for at least 2 full statement cycles, meaning leave it untouched for over 60 days before you even apply for a loan. By then, it's just part of your established account balance. Next on the unacceptable list are new unsecured loans. You cannot take out a personal loan or a payday loan to fund your down payment. This is called borrowing your down payment, and it's a cardinal sin. It artificially lowers your debt-to-income ratio on paper, but in reality, you've just taken on more debt, making you a much riskier borrower. Same goes for cash advances from credit cards. Lenders see that as a sign of financial desperation. Now, once the lender has verified where all your money is coming from, they shift their focus to the money you'll have left over after the transaction is complete. These are your cash reserves. Think about it from their perspective. They're about to lend you hundreds of thousands of dollars. The last thing they want is for you to drain every last penny you have to close the deal, leaving you with a $0 balance in your checking account. What happens if the water heater explodes a week after you move in? What if you have an unexpected medical bill? If you have no cushion, the very first financial emergency could put you at risk of missing a mortgage payment. To prevent this, lenders require you to have a certain amount of assets left over after you've paid your down payment and all your closing costs. This reserve requirement is calculated in terms of months of your total housing payment. And that payment is often referred to by the acronym PITI: principal, interest, taxes, and insurance. So if your total monthly mortgage payment, including property taxes and homeowner's insurance, is say $3,000, a lender might require you to have 2 months of PITI in reserves. That means you'd need to show you have at least $6,000 remaining in your accounts after closing. For conventional loans, 2 months is a common minimum. For jumbo loans or investment properties, the requirement can be much higher: 6, 12, or even 18 months of reserves. These reserves don't have to be in cash in your checking account. Lenders will typically count retirement accounts like a 401k or an IRA as reserves. They might only count a certain percentage of the vested balance, say 60 or 70%, to account for taxes and withdrawal penalties, but it still counts. Stocks and mutual funds can also be used as reserves. Having strong reserves does more than just check a box for the underwriter. It paints a powerful picture. It tells the lender that you are a financially responsible person who plans ahead. It shows you aren't living on the edge, and you have the stability to handle the inevitable costs and surprises that come with homeownership. In a borderline case, having 6 or 8 months of reserves instead of the minimum 2 could be the single factor that pushes your application from a maybe to a resounding approved. So as you prepare to buy, don't just focus on saving for the down payment. Think about the sourcing of those funds and the reserves you'll have left. Document everything. Avoid large, sudden deposits, and build that post-closing cushion. Because you're not just proving you can afford to buy the house, you're proving you can afford to keep it. You're showing the lender you've successfully navigated the financial gauntlet and are ready for the final step: the terrifying, meticulous, and all-important final underwriting review, where one last human being holds the fate of your file in their hands. This final underwriter is the lender's last line of defense, the gatekeeper. Think of them as the quality control inspector at the end of an assembly line, the one who gives the final critical look before the product gets shipped. Their job, to put it bluntly, isn't to find a way to approve you. Their job is to find any remaining reason to deny you. They are paid to be skeptical. They are paid to protect the lender's money, and they do that by stress testing every single piece of your file one last time. So what are they scrutinizing with this fine-tooth comb? First and foremost, consistency. They are reading your file not as a collection of documents, but as a single cohesive story. And they are looking for plot holes. Does the name on your driver's license exactly match the name on your bank statements and your pay stubs? A missing middle initial on one document might seem trivial to you, but to an underwriter, it's a red flag. It's an inconsistency that must be explained. Does the address on your utility bill match the address on your application? Do the deposit amounts on your bank statements line up with the net pay on your pay stubs? Any discrepancy, no matter how small, creates a question. And every unanswered question is a potential reason for denial. They will cross-reference everything. They'll look at the date you said you started your job on the application and compare it to the hire date your employer gave during the verification of employment. If those dates are off by even a week, they'll want to know why. Every inconsistency is a loose thread that could unravel the entire tapestry of your financial life. Next, they are reevaluating every single risk factor. They're looking at that large recent deposit you sourced with a gift letter and asking, is this truly a gift? Is there any chance this is a secret loan that will affect the borrower's ability to pay? They're looking at your debt-to-income ratio and asking, is this stable? Is there any indication this borrower is about to take on more debt? This is where the absolute most critical rule of the home buying process comes into play. From the moment you are pre-approved until the moment the keys are in your hand, you must become a financial ghost. Do not make any large purchases. Do not finance a new car. Do not buy a house full of furniture on a credit card. Do not co-sign a loan for anyone. Do not change jobs. Do not even deposit a large amount of cash into your account without talking to your loan officer first. Why? Because the final underwriter will perform what's called a soft pull on your credit just before closing. It's a final look to see if anything has changed. And if a new loan or a massive new credit card balance suddenly appears, that can be a catastrophic deal killer. Your debt-to-income ratio, which was perfectly fine a month ago, could suddenly be too high. The loan is denied. It happens more often than you can imagine. I once saw a deal fall apart 4 days before closing because the couple bought a new refrigerator and stove on a store credit card. The inquiry and the new balance popped up on the final credit check. Their DTI shot past the acceptable limit, and the underwriter pulled the plug. They lost the house over a $2,000 appliance purchase. Don't let that be you. Freeze your financial life. The final underwriter also takes one last, hard look at the property itself. They'll review the appraisal in detail. They're not just checking to see if the value is high enough. They're reading the appraiser's comments. Are there any signs of deferred maintenance, like a leaky roof or a cracked foundation? Is the property in a declining market? Are the comparable sales the appraiser used truly comparable? If the collateral, the house, seems risky, it makes the entire loan risky. They will also verify that you have secured a homeowner's insurance policy and that the coverage is sufficient to rebuild the home if disaster strikes. Again, it's all about protecting the lender's investment. They'll review the title report to ensure there are no liens or claims on the property. They need to know that you will be the clear and rightful owner, and therefore they will have the first and primary claim on the property if you default. It's a final check on the legal health of the asset you're buying. After this final grueling inspection of your life, your finances, and your future home, if the underwriter finds no new risks, no inconsistencies, and no red flags, then it happens. After days of silence that feel like years, you get the 3 most beautiful words in the home loan process: clear to close. This is the summit of the mountain. It means the lender is fully satisfied. The funds are ready. The finish line is in sight. Your loan officer will call you, and you'll schedule your closing. At the closing table, you'll be faced with a stack of documents that looks like a phone book. Don't be intimidated. You'll be signing your name over and over, but there are only a few key documents to understand. The first is the closing disclosure, or CD. You should have received this at least 3 days prior to closing. It's the final itemized list of all costs, credits, and the exact amount of money you need to bring. The second is the promissory note. This is your IOU. It's the legal document where you promise to repay the loan, detailing the interest rate, the term, and the monthly payment. The third is the mortgage or deed of trust. This is the security instrument. This is the document that says if you don't honor the promise you made in the promissory note, the lender has the right to foreclose and take the property. You'll sign, you'll slide a cashier's check across the table or confirm a wire transfer, and then the closing agent will hand you a set of keys. And just like that, it's over. You're a homeowner. Looking back, from the very first step of checking your credit score to this final signature, the entire process has been about one thing. Lenders are not looking for perfection. They are not looking for you to be wealthy. They are looking for predictability. They are looking for a borrower who is stable, responsible, and well-documented. They want to see a clear, consistent story that demonstrates you are a low-risk, and have the proven ability to handle your financial obligations. Every document you provided, every question you answered, every hoop you jumped through was designed to prove that one thing. Building your credit showed you have a history of predictable payments. Saving for a down payment showed your financial discipline and predictability. Maintaining a low debt-to-income ratio showed you live predictably within your means. Having stable employment showed you have a predictable source of income. Sourcing every deposit showed that your financial life is transparent and predictable. The home loan process can feel invasive, overwhelming, and even unfair at times. But it's not a mystery. It's a formula. It's a system designed to measure risk. And now, you understand that system. You know what they're looking for at every stage. You are no longer just a passive applicant hoping for the best. You are an active participant who can prepare, anticipate, and present the strongest possible case. You have the blueprint. You know what American home loan lenders are looking for. Now go out there, tell your story, and turn that dream into an address.